Well, good morning, Jaginder Rana here. The topic of the day is credit risk insurance. Credit risk insurance. Let's understand what it is and what it is not. How does it help? Underwriting philosophies, policy types, avoid documentary pitfalls associated with claim perfection, and benefits to exporter and foreign buyer. The globalization is there. That refers to the more aggressive sales strategies because higher risk emerging markets are there. Financing includes key purchasing considerations and increased credit exposures. So let us understand what is credit risk insurance. Credit risk insurance means protection of AR from two default triggers, that is commercial default, which includes insolvency, devaluation or protected default, and political default. It includes transfer risk, arbitrary government action and civil unrest. What it is not, it's a tool to make a bad credit good. It renders a good credit acceptable in a high risk market. How does credit insurance help? In fact, credit risk insurance will enhance competitiveness. It will enhance financing options, and it will also enhance protection against payment defaults. So, what is credit risk insurance? The purpose is to expand sales, improve financial options, and mitigate payment risk. Simultaneously, it exploits payment risk to competitive advantage. It covers commercial and political risk, but it does not cover product disputes or contract cancellations. It is conditional because claim payment will be made only if insured can demonstrate conformity to the policy's terms and conditions. Now the question is, who uses credit insurance? In Western Europe, you will find 83% of world market, where Germany is 26%, France is 18%, UK is 13%, and rest of the world 17%, of which North America uses only 6%. So US firms typically insure finished goods, work in progress, building or equipments, and the people. Accounts receivable portfolio means AR is your second most fluid assets after cash timed payment obligations, yet over 94% of open account sales in US are uninsured. As far as policy types are concerned, you will find short-term multi-buyer policy or single-buyer policy. Medium-term single-buyer policy is there, then leasing, that is operating or financing, and bank's letter of credit. A standard multi-buyer policy is used for multiple sales, buyers, countries. It's of short term, say from 30 days to 360 days or 12-month period. Policy has annual deductibles. Through this policy, spread of risk is there because all open account sales are there. Then premium is based on risk or exporter's experience. Ledger and credit DCLs available. Coverage is 90% to 100%, and it is assignable. Short term single buyers means short term again refers to 30 to 60 days, 12-month policy period. One or more shipment is there. Premium rates schedule is there for export import. Negotiable premium private sectors are there. Minimum advance premium payments and no deductibles or assignables are used. But the medium term policy is there for the term of 1 to 7 years, used for export import bank. 15% down, other restrictions apply because comprehensive coverage is there, focus is more on foreign buyers obligations. A relatively short processing is there. Why? Because private sector programs available like EIC, FCIA, Unistart, Zurich, AIG. So these private sector programs are there. Then evaluating an application. For evaluating an application, major items needed are financial statements, sales volume, that is domestic and international, average AR balance, 3-year loss history, analysis of credit procedures, financial information on top tier buyers, financial banks and trade references, favorable credit agency reports, desired credit limits. For export program, sales by country breakdown. Pricing is based on the country risk, industry risk and buyer risk. Terms of payments means the term of payment are more liberal. Your terms, the less quality in your AR time increases uncertainty of payment, and loss record is required. Deductibles are applicable as per losses upon sales into projected sales. So this benefits to exporters are there. If you will see benefits for exporters, because they enhanced overall competitiveness, you will find. Then contribute to bottom line, improve cash flow, reduce DSO, lower loss reserves, increase collateral base and borrowing power, mitigate chances of payment default, and premiums are tax deductible. Benefits to foreign buyers means letter of credit, that is cost avoided, not forced to borrow locally. US international rates are applicable and 100% of financing of short-term credits. Replaces letter of credit because letter of credit do not guarantee payment. Letter credits require expertise. Letter of credit may cost the sale. Letter of credits tie up buyers' funds or credits. Insurance eliminates high local international rates. Insurance eliminates buyers' bank fees. Insurance builds customers' loyalty. Almost all international players are doing it. So this is the letter credit risk insurance overview, which is applicable internationally. Thank you very much.